Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
It certainly has been quite a week, lots to unpack.
Absolutely, a lot of significant financial news swirling around. So today, we're going to try and cut through some of that noise, really make sense of the key stories that matter for you.
Exactly. This isn't just, reading the headlines. We want to dive deep, understand what these stories really signify for the broader economic picture,
Okay.
and maybe see what paths might lie ahead.
Okay.
We've got a really interesting set of sources today, and the mission really is to connect those dots for you, help understand the underlying trends.
Sounds good. So looking across the big financial magazines, a few key themes keep jumping out, don't they?
They really do.
Lots of talk about economic growth or maybe the slowing pace of it, tariffs, still a huge topic,
Yeah.
and how all this is shaping what big companies are expecting.
Yeah, and then there's the labor market picture, the energy sector, always volatile,
Yeah.
and some pretty fascinating moves in crypto as well.
Right. So quite a bit to cover in this deep dive.
Absolutely. Let's start with those corporate outlooks, the economic uncertainty they're wrestling with.
Yeah.
That Market Watch piece on Airbnb seems like a good place to kick off.
Yeah, okay. So Airbnb, they announced they're expecting slower growth in nights booked for Q2.
Mm-hmm.
And they explicitly linked this, the article says, to broader economic uncertainties in the U.S., which, makes you wonder, is this just Airbnb? Or is it maybe the canary in the coal mine for the wider economy?
That's the big question, isn't it? And what's interesting, as Market Watch points out, is even with that slower booking forecast for Q2, they're actually keeping their full-year guidance for adjusted EBITDA margin.
Okay, so profitability outlook is stable overall for the year.
Right, that's a measure of their core operating profit. But they do expect that margin to be flat to down slightly, specifically in Q2.
Why is that?
Well, they're planning to ramp up marketing spend, plus investments in expansion. And they've also earmarked something like $250 million for new business ventures in 2025. We should get more detail on May 13th, apparently.
So acknowledging potential headwinds, these uncertainties, but still plowing money into future growth.
Exactly. And it's interesting, they specifically brought up their adaptable business model, even mentioned being founded back during the Great Recession.
Right. Sort of like saying, hey, we've navigated tough times before, we can handle this.
Yeah, that adaptability is definitely part of their narrative.
Yeah.
Now let's maybe switch gears to another tech giant, Amazon. MarketWatch covered their Q1 report and outlook too. And again, tariffs and cloud growth AWS were big talking points.
Always under the microscope, Amazon. CEO Andy Jasse, the report said, really emphasized keeping prices competitive, especially with those tariff worries hanging around.
Which is key for them.
And their advertising business, that showed really strong growth, didn't it? Like 17.7%.
Yeah, quite impressive. They're also spending more, significantly increasing capital expenditures on things like property and equipment.
What were analysts saying? The Market Watch piece mentioned some different takes.
It was pretty nuanced, actually. Some felt Amazon's outlook, while maybe cautious, could have been worse given everything going on. One analyst used the word choppiness for the near term, but still saw longer-term expansion.
Right.
And crucially, Jassy said they haven't seen any attenuation of demand yet in e-commerce, which is a pretty positive sign for consumer spending, at least for now.
Okay, that's encouraging. Now, Apple, also Market Watch. They had solid earnings, but the stock price took a hit afterwards. What was driving that, do you think?
It really seems like it was uncertainty again.
Yeah.
Specifically, the vagueness around how tariffs might impact them beyond the current quarter, beyond June.
Okay.
They did estimate about $900 million in extra costs for the June quarter if tariffs stay as they are now. But beyond that, less clear. And, markets really don't like that kind of forward-looking ambiguity.
No, that lack of visibility definitely makes investors nervous, even though, interestingly, their iPhone sales actually beat expectations.
Right. But revenue from services and, importantly, Greater China was a bit weaker.
And they're actively trying to shift things around, aren't they? Moving iPhone imports to the U.S. from India, other products from Vietnam, clearly trying to mitigate those tariff impacts.
Exactly. They're adapting. And one analyst quoted in the piece expressed confidence in Apple's ability to navigate this. They have a track record. But still, that immediate uncertainty about the longer-term tariff situation seems to be weighing on the stock price.
So, okay, if we kind of pull these threads together, Airbnb citing uncertainties, Amazon dealing with tariffs but seeing demand hold up, Apple facing investor jitters over future tariffs, it really paints a picture, doesn't it? This backdrop of economic uncertainty and trade issues is clearly shaping how these huge companies see the near future.
Yeah, and influencing investor sentiment along the way. It's a
Yeah.
really clear common thread.
Okay, so that connects nicely to the labor market then. How might these uncertainties and tariffs filter through into hiring? Bloomberg had a report on the April jobs report expectations.
They did. And the expectation was for a slowdown in U.S. hiring in April. The estimate for non-farm payroll growth, that's new jobs outside farming, was around 138,000.
Which is moderate, I guess.
Moderate, yeah. And the jobless rate was expected to hold steady at 4.2%. But the report also flagged the possibility of a sharper slowdown in hiring come May.
Interesting. Did they mention specific sectors?
Yeah, particularly logistics and leisure hospitality. Those are often quite sensitive to broader economic shifts, changes in consumer spending.
Makes sense.
And the report also raised the idea that trade restrictions, these ongoing tariff issues, could start to become more noticeable drag on overall payroll numbers in the months ahead.
And Bloomberg also mentioned some other factors, right? Like seasonal adjustments, maybe reduced immigration affecting the labor force size.
Exactly. Those contextual factors are important.
Hmm.
Lower immigration could, contribute to a lower unemployment rate, even if actual hiring is slowing down a bit.
So lots for the Fed to watch there.
Oh, absolutely.
Yeah.
They'll be watching these labor market developments very closely as they think about the economy's health and, well, any potential monetary policy adjustments down the line.
So linking this back, if we see this expected moderation in hiring, plus the concerns from companies like Airbnb, Amazon, Apple, it does start to feel like these pieces are pointing towards a potential broader cooling of the economy.
It certainly seems that way. The picture becomes a bit clearer when you connect those dots. Okay, let's shift again. Oil markets, always a complex beast.
Right. Trade wars, geopolitics, OPEC plus decisions. It's all in the mix. Bloomberg had several reports on this.
Yeah, it looks like oil was heading for a weekly loss. Those trade war developments were definitely a factor. Brent crude prices were down. WTI, the U.S. benchmark, was holding below $60 a barrel.
That $60 mark is always kind of a psychological level, isn't it?
It is. Now, China hinting at potential trade talks did provide a little bit of support. But then you had concerns about OPEC, plus potentially increasing supply, which would push prices down.
And didn't President Trump renew talk of sanctions on Iran?
Yes, secondary sanctions on Iranian oil. So that adds another layer of geopolitical risk and potential supply disruption, or at least fear of it. It's this real push and pull.
Potential trade de-escalation on one side, a potential supply increase from OPEC plus and Iran risks on the other. Talk about volatility.
Exactly. And that volatility is hitting the companies. Bloomberg reported Chevron decided to slash its share buyback program pretty significantly.
And they blamed falling oil prices directly.
Explicitly, yeah. That 17% drop in oil prices this year is having a real tangible impact on how they allocate capital.
Wow, 17%. And did their CFO comment on the outlook?
Yeah, Amir Bonner mentioned a softening supply and demand picture. And interestingly, directly linked Trump's tariffs to potential negative effects on demand and also on their own production costs.
So tariffs hitting them from both sides, potentially.
Seems like it. And their reduced buyback, while still a lot of money, signals caution. RBC Capital Markets put their break-even oil price what they need just to cover everything at around $95 a barrel this year.
$95. Okay, that really puts the buyback cut into perspective. That's quite high.
It is higher than some competitors.
Okay.
Which brings us, interestingly, to ExxonMobil. Bloomberg reported on them too, and they had a pretty different response.
Oh, really? What did they do?
Well, they actually met earnings estimates and said they're maintaining their share buyback program despite the oil slump.
How are they managing that?
Their strategy seems really focused on boosting production from their low-cost projects. Think Guyana, the Permian Basin. CEO Darren Woods expressed confidence in their resilience, their ability to make money even now. RBC put their break-in lower, around $88 a barrel.
Okay, so $88 versus $95. That difference likely explains the contrasting strategies. Chevron pulls back. Exxon presses ahead, relying on low-cost barrels. Fascinating.
It really highlights the different paths companies take in the same challenging environment. And then adding yet another layer, MarketWatch had that piece about the U.S. maybe using Saudi influence on oil to pressure Russia.
Yes, the geopolitical angle. How did that work?
Well, it pointed to the Saudis recently restoring some oil production capacity. That helped push crude prices down, as we mentioned.
Right.
And the theory floated is that this might be, a coordinated move, maybe with the U.S., to squeeze Russia economically, perhaps Iran too.
The timing, with Trump's visit to Riyadh planned, makes that plausible.
It does. And you had Senator Graham proposing new sanctions, tariffs on Russian energy specifically. It all fits that narrative.
But MarketWatch also said the White House has a tricky balancing act, right?
Exactly. Lower oil prices are good for U.S. consumers, kind of like a stimulus. But they also want to encourage domestic U.S. oil production, which lower prices don't really help. It's a very delicate dance.
So yeah, the oil market is far from simple supply and demand. Trade wars, OPEC strategy, geopolitics. It's an incredibly intricate web influencing prices and company decisions like Chevron's versus Exxon's.
Precisely. Okay, let's make another shift. Cryptocurrencies. Also seeing some notable action and interesting dynamics lately. Bloomberg and MarketWatch both had reports.
Right. Bitcoin getting close to $100,000. Bloomberg said it hit its highest since February. It seems like risk appetite is back a bit.
Yeah, that seemed to be the driver. And Bloomberg highlighted increased inflows into Bitcoin and Ether ETFs.
Exchange traded funds. Okay.
Yeah. But interestingly, relatively low demand for leverage for borrowed money trading and more interest in call options way up at the $100,000 strike price.
So people betting on a big move up, maybe more momentum chasing?
Could be. It suggests a certain kind of market dynamic. But then Bloomberg also had a report about Bitcoin miners really struggling.
Yeah.
Which feels like a bit of a disconnect, doesn't it? Bitcoin price up, miners struggling.
Yeah, how does that work?
Well, despite Bitcoin being high earlier in the year, many U.S.-based miners are apparently expected to post losses for Q1.
Losses? Why?
A few things hitting them at once. More competition among miners, tariffs on the actual mining machines they need to import.
Yeah, tariffs again.
Yep. And just overall lower mining revenue per unit of computing power, even with the high Bitcoin price earlier. The network difficulty keeps rising. Energy costs are up in places.
So Trump's policies, maybe seen as crypto-friendly overall, are actually hurting the U.S. miners through these tariffs on hardware.
That seems to be a key part of it, yeah. The Bloomberg piece said aggregate adjusted net income for the big public U.S. miners dropped significantly year over year, and they're projected to report a net loss as a group for Q1.
Ouch. That must make it hard to fund expansion.
Definitely. It's tougher to raise capital, some are turning to debt. And then you had the Bitcoin halving event last April, which cut mining rewards in half. That's still putting pressure on them, too.
So a really tough operating environment for miners, even if Bitcoin itself is doing well price-wise.
Okay, what about MicroStrategy? They always make crypto headlines. Bloomberg reported a huge loss.
A record $4.2 billion Q1 loss, yeah. The specifics weren't detailed in the available report, but it's almost certainly tied to the value fluctuations of their massive Bitcoin holdings.
Makes sense. But MarketWatch had Michael Saylor, their CEO, justifying the huge premium MicroStrategy stock trades at compared to the value of the Bitcoin they actually hold.
Right, Saylor's strategy is, well, unique. He's arguing MicroStrategy is more than just a Bitcoin bucket. He compared it to brands like Domino's or Diet Coke, talking about brand recognition, first mover advantage, and institutional crypto.
A crypto reactor, he called it, and pushing for a U.S. strategic Bitcoin reserve.
Yeah, that's the narrative he's building, trying to justify that gap between market cap and the net asset value of their Bitcoin. It's a bold play. He also wants a credit rating for their bonds, apparently, but the agencies seem hesitant, likely because of that Bitcoin volatility. So, okay, crypto land. We've got Bitcoin price looking strong, renewed risk appetite maybe, but the miners who make it work are under pressure, and then this very unique MicroStrategy situation. Quite the mix.
It really is a fascinating dichotomy. Price momentum versus operational challenges. Okay, let's broaden out again. The stock market overall. We saw reports from Bloomberg and MarketWatch about a recent rally. S&P 500 looking strong for a bit there.
Yeah, that hint from China about being open to more trade talks seemed to really give sentiment a boost, didn't it?
It certainly appeared to. Bloomberg noted the S&P 500 was aiming for potentially its longest winning streak in a while. We saw gains in Europe, Asia too. The dollar weakened. Treasuries were pretty stable ahead of the jobs report.
Feels like investors were maybe betting on, I don't know, an easing of trade tensions, maybe a more market-friendly Trump stance coming. Plus, the expected slower job growth might have played into it too.
Could be. One commentator in the Bloomberg piece suggested we might have hit peak policy uncertainty, at least for now. That combination, potential trade progress, earnings season being generally okay, seemed to create some short-term optimism.
But MarketWatch had an interesting angle, saying the speed of that rebound from the April tariff scare really stunned Wall Street.
Yes, they highlighted how several indicators showed stocks got really oversold during that April dip.
Okay, technically oversold.
Right. And interestingly, they pointed to a bit of a split. Individual investors seem more eager to buy the dip, even using leverage, while institutions were maybe more cautious.
So retail enthusiasm helping drive the bounce. Along with those technical signals like RSI, MACD showing oversold conditions, MarketWatch mentioned bearish sentiment was extreme too, the VIX spiked.
Exactly. All signs of a potential short-term bottom. They even mentioned a technical pattern called the Swag Brett thrust, which sometimes signals renewed confidence.
But crucially, MarketWatch also noted this rebound was largely technical, right? No massive breakthrough on tariffs yet. The S&P 500 still had work to do, like reclaiming its 200-day moving average.
That's a very important caveat. The underlying issues hadn't vanished. The rally had legs, but the fundamental uncertainty wasn't fully resolved.
Okay. Now thinking about valuation, MarketWatch also flagged that Warren Buffett's favorite indicator was apparently flashing a buy signal. Always pay attention when Buffett's name comes up.
Absolutely. The Buffett indicator, it compares the total U.S. stock market value, basically the Wilshire 5000 index, to the country's GDP.
Right.
And MarketWatch reported it was at its lowest level since early September. Buffett sees this ratio as a key gauge of overall market valuation. So its current level suggests stocks might be relatively cheap by that measure anyway.
Relatively cheap. Though the article did say it's still above the levels seen in past major market bottoms, like during the COVID crash.
Correct. It's not screaming bargain basement like it was then, but it does add some weight to the idea that maybe the market wasn't wildly overvalued, especially after the dip. And it makes you wonder.
If Buffett himself has been buying, with Berkshire Hathaway's big annual meeting coming up this weekend, that's the multi-billion-dollar question, isn't it? Did he deploy that huge cash pile?
Exactly. Everyone will be watching for clues on that. And speaking of Berkshire, MarketWatch also had a piece pointing out how Berkshire's stock has actually been outperforming the broader market recently amidst all this tariff and economic uncertainty.
Yeah, that's interesting. The article compared it to how Berkshire did well during past crises, like the financial crisis or the dot-com bust.
It really speaks to Buffett's long-term strategy, doesn't it?
Yeah.
Buying good companies at decent prices, having that patience, holding cash when things look expensive, it seems to offer some resilience in choppy waters.
Yeah, his discipline seems to be paying off again, perhaps. Okay, now for a complete change of pace. Space pollution. Bloomberg Green had a report on falling satellites.
Yeah, the Big Take report. So really interesting, maybe overlooked issue. Basically, with so many satellites going up now, especially from SpaceX's Starlink, Amazon's Project Kuiper, eventually they come down.
They burn up on reentry, right?
Mostly. But the report argues the atmosphere is effectively being used as a giant waste incinerator, and the sheer volume is becoming significant. Think potentially dozens of satellites deorbiting every day just for these big constellations.
Wow. And the environmental impact isn't fully understood?
Not really. The Bloomberg piece points out our environmental laws don't really cover this properly yet. There's early research suggesting potential risks to the ozone layer from the soot and particles released, maybe even indirect effects on weather patterns.
Huh. With the satellite industry booming, that sounds like something we need to keep a serious eye on.
Definitely. An emerging environmental challenge linked to this new space race. Okay, one last item. A specific company situation from Bloomberg. JSW Steel in India.
Right. Their plan to acquire Bhushan Power and Steel got rejected.
By India's Supreme Court, yeah. They said the plan didn't conform to bankruptcy laws and ordered Bhushan Power and Steel to be liquidated instead.
That's a big setback for JSW Steel. They'd already acquired the company back in 2021.
It is. Their stock price dropped on the news, and now they have to figure out their next steps. A significant legal hurdle there.
Okay, so wrapping up our deep dive for today. It feels like we've seen this recurring theme of economic uncertainty, largely fueled by tariffs and global events.
Definitely. And we saw how that's hitting corporate outlooks, potentially slowing the labor market, creating volatility in commodities like oil.
Yeah, well, meanwhile, crypto shows this strange mix of bullish price action, but stress underneath for the miners, and MicroStrategy doing its own thing.
And the broader stock market staged that surprising rebound, but maybe on shaky technical ground, with valuation questions lingering, even as classic value strategies like Berkshire's seem to be holding up well.
Plus that emerging issue of space pollution. It's a complex picture.
It really is. Understanding how all these pieces connect trade, corporate strategy, market sentiment, geopolitics, even these newer environmental factors, it's essential if you want to navigate the current financial landscape.
Absolutely. Well, hopefully this discussion helped bring some clarity and deeper insight into the week's major financial stories for you. We've covered a lot of ground.
Always good to connect the dots.
Indeed. And with that, we'll see you all Monday morning with new headlines from major financial magazines.